Yeah, I think things are actually going to get a little bit better. You know, the market was spooked earlier today by some hawkish talk from Wayland Daily. Bostic did a little walk back, and Jamie Dimon was talking about hurricanes, and no one knew what to make of that. But I watch what people do, not what they say. And what I watch is Warren Buffett, one of the best to ever put a third of his cash to work since the beginning of the year, 50 of $150 billion. And if you look at who's buying and who's selling, well, the outsiders are selling. There was a Goldman Sachs note out this week that retail investors have sold all the stocks that they purchased during the first 2 years of the pandemic as of recently. While on the one hand, the retail's sold all of their stocks in the whole. On the other hand, insider buying is nearing highs here, the highest level since the pandemic lows. That is executives of their corporation who have perfect information about how their business is doing. They're in the market buying while things are on sale. And that really tells me everything that I need to know.
But of course, Tom, you did mention that Jamie Dimon comment, which I have to follow up on. He has some pretty good data there as well. Brace yourself for an economic hurricane caused by the Fed and the war in Ukraine. That's an upgrade from storm clouds. What do you make of it? What is he seeing that you're not?
Well, look, Jamie is an absolute legend, but he thinks like a bond guy. And equity guys are always optimistic. Bond guys are always pessimistic. Bond guys are smarter than equity guys, but they're often too pessimistic. So, look at the level of pessimism here. First off, you've got companies that have announced $429 billion of buyback since the start of the year. That's stronger than 2019 and 2021. That could put some support under the market. You've got end of quarter rebalancing coming in. JP Morgan estimates $250 billion will have to be put to work to buy equities for pensions and for sovereign wealth funds. And sentiment, like Jamie, is completely washed out. We saw it in the Bank of America Global Fund Manager Survey this month. Highest cash balances since 9/11 and since the Great Financial Crisis. Those were two generational buy opportunities. Most underweight stocks since May of 2020. That was near the pandemic lows before we had a vaccine, before we had antivirals. And the most crowded was short tech. Highest shorts in tech since August of 2006. You know what happened in the next year and a half? Tech was up 42% over the next 18 months. So I think that certainly there is cause for concern. We know that default rates are going to go up, and that's what probably Jamie's talking to on the credit cards and et cetera. But at the same time, earnings estimates continue to go up every week. And until those estimates drop materially or rates spike materially, I think we're generally in an okay range here. It might be a trading range back up to those highs and back down to these recent lows. But on balance, the economy is pretty strong at this time.
So, Tom, how much of the Fed's tightening plan then has already been priced into the market? It sounds like pretty much most of it from your perspective.
Well, there's no question. I mean, you saw the two-year yield up to 271 just a couple of weeks ago. That implies quite a bit, considering they're talking about 250 basis point hikes and possibly a pause. And then you saw in the Fed minutes they were talking about long-term expectations is what they're focused on. Long-term expectations. And what's happened with five-year break-evens in the last few weeks since March 25th? Five-year break-evens have gone from 3.59%. They've dropped to 2.96%. You had the biggest drop in 10-year break-evens recently. And that's really what the Fed's focused on. Because if you look in the short term, most of the commodity basket, X energy, is actually rolling over in the recent weeks and months, from cocoa to coffee to lumber to copper to lean hogs to soybean meal. They've literally been rolling over and in some cases almost collapsing, whereas energy's had this Russia-Ukraine premium. But if you look at the forward curve for energy, even so, Shauna, it's in backwardation. And backwardation usually points to positive things, meaning oil prices come down, cash price around 115, December 2023 around 87, December 2024 future around 78. So maybe we'll get some relief. There's been some rumors that they're going to kick Russia out of OPEC Plus so that Saudis and UAE can put some of their excess capacity online. That's just a rumor. It would be a great blessing. We won't hold our breath. But that's the last commodity really holding up aggressively. And then finally, what no one's talking about, Shauna and Dave, the dollar has started to weaken and to moderate. It was a headwind for earnings in the first half of this year, as you heard from many companies. You even heard from Salesforce last night to the tune of $600 million. But the back half, it may prove to be a tailwind. And that's what we see in the commitments of traders report based on how commercials have been positioning short in recent weeks and months. That could lead to some moderation in that dollar strength, which would certainly help earnings in the back half.
You mentioned energy. We've got the China lockdowns coming to an end. You've got Europe banning 90% of Russian imports by the end of the year. And Jamie Dimon, we talked about before, calls for $150 to $175 oil. You disagree with that?
Well, I'll tell you, one thing that I look at is the action of the producers, right? So if you look at the rig count, it got down to 244 in the pandemic lows. It's back up to 727. So the rig count's up 192% off the lows. The pre-pandemic levels right before the pandemic was 792. At 727, that production is going to come back online a lot faster than people think. Sure, could we have some short-term spikes into driving season? It's certainly not out of the question. However, again, based on how commercials are positioning, based on that supply coming back online, based on the possibility of everyone's position for the worst case. What happens if the best case? What happens if there's a little bit of easing between Russia and Ukraine? You can't bet on that, but it's not out of the question. Or if you see OPEC do put Russia out for a little bit and bring that excess capacity online. So these things are possibilities, not probabilities, but I am watching that rig count and I do see supply coming, and the forward curve tells me everything I need to know about where prices are headed over the next 6 to 18 months.